Hey guys, it's Valentine here. So I wanted to go more into depth of the, you know, mortgage lending part of buying a property. So my advice is always, before you buy a property, it's preferably you speak to a loan officer. Of course, you can use my loan officer. His name is Gary Powell from San Antonio, Texas. Of course, if you contact me, I can help you out. He's senior loan officer. But using your bank is a good idea because they're probably going to be a better lower interest rate. But the problem is your loan application is going to pass so many people's hands. So you'll start with a low level guy that takes applications, so he gets paid $8-9 an hour or some kind of commission per application. And the next guy. What's wrong with this is if you're one of those persons that your credit's not that good, or you might find some kind of discrepancies in your contract when you're actually on your contract and the property and you're about to close in the next 15 days. Well, if the person is not I'm going to say it, a senior loan officer, he hasn't seen every scenario. So the purpose of a senior loan officer, which your local bank will probably use at the very end, he's not going to get you to the finish line. And I know you might be saving half a percent. Let's just say half a percent. All the money, the appraisal money, the option money, the earnest money, and I'll talk about that later. You'll end up losing all that if you lose the deal on the property. So I had mentioned it earlier, a VA loan. Well, of course, if you're in the military, you qualify for a better VA loan, which means you'll be working with two different banks, and just because the VA bank and then the bank you choose will use the VA, and they'll correlate with each other. The thing with the VA is yes, it's a 0% down. You don't pay anything out of pocket. Only the closing costs if your realtor didn't find a way to make sure the seller paid for the closing costs. It's usually about, if you're buying an owner occupied, you can ask 4%, and if it's an investment, you're only allowed to ask for 2%. And I'm going to say this again because this is something that a lot of young investors don't know. When you're asking for closing costs, since you're probably coming between 20 to 30% of the loan amount, you're only allowed to ask for 2%. Now, I am talking about Texas, so if you're in a different state, you might have to speak to your loan officer and see what they say there. So on a VA loan, the VA loans are very, very difficult. They're phenomenal because I'm 0% down, but they don't really like working with other people. They're not very fair, But after people close, they kind of tend to forget that it wasn't a very easy process. Or your loan officer is so phenomenal that he just doesn't keep you informed of how difficult they really are. But it's still a good loan. The other loan is a USDA loan. Every city has some kind of county area where it's outside the city limits. There's a map you can pull up. You don't have to ask a realtor. You can go on USDA and look at the map and type in the address of the property, and it'll tell you, if this is USDA restricted or not, and which means it's once again 0% down, which is it's really, really good, But of course, it has safety systems, and that's a different ball game. If you're used to be living in the city and having city water, city pressure, electricity, and all the basic utilities. But I mean, people want acreage and they want a house now, and all they have is $3,000-4,000. It's probably the way to go. Another one is, and I'm gonna explain this to you a little bit if you don't understand a little bit about politics. So before Obama came into office, the interest rates used to be 3%. When he came into office, rates went up to 3.5%. And I always say this, but that Obama didn't like poor people because, why would he raise the rates on FHA loan, which is first-time home buyers, which means you would have to put more money at hand down And before he came into office at 3% down, if you reach 80% of the property's value, you could get your MA removed. So that's mortgage insurance. So this is an insurance you're going to be paying between $80 to $150 a month based on your loan amount, to protect the bank in case you foreclose. I mean, the bank's saying, hey, we'll put this different insurance, but to protect ourselves, just in case you decide not to pay for the property and walk away. So that's the reason that's there. But when Obama came in, he says we're gonna do 3.5% of the loan amount, but the MA never goes away unless you refinance into I guess possible conventional or FHA loan. But as of 6 months ago, the interest rates have gone from 3.5 up to 4.5, 4.7, and they're on their way up to 6%. I hope it's not a speedy process because I'm still buying properties. So Obama, I don't know why he decided to do that. Of course, if you have a lot of money, you're gonna say, well, it's good for the economy. Not for the first-time home buyer, knowing that your rate's not gonna go down, and they're gonna say you're gonna refinance. Why would you refinance? Why would you refinance at a higher rate? That doesn't make any sense. Why would you pay more? Just to get rid of your mortgage insurance and save $20? Doesn't make any sense. Sorry, that's my Pandora in the background. I like Karen Marie Garrett's classical music. The other loan is conventional loan, which means it's 5% down. So whatever the loan amount, you just do the loan amount times 0.05%, and that tells you what 5% is. The good thing about 5% is the mortgage insurance does disappear, which means your monthly payments are going to be lower because you're putting a higher amount down. But just so you know, for every $1,000 you put down, the interest rates the monthly payment is only going down $10 down. I mean, the math is so precise that if you put $2,000-$3,000, you're only saving $30,000 on your mortgage payment. It's good and bad. It's good if an investor, you put down a little bit more, but as an investor, the more money in your pocket, well, the better. You can invest that money somewhere else. But the good and bad thing is this: if you're gonna live in a property and you do 5% down, you're gonna have a lower mortgage payment. But the city is always gonna fight you every year, to raise your taxes. They're gonna say your property is valued at a higher rate, and of course you're gonna have to hopefully when you buy your property within that year, file for a Homestead Act. Don't forget that, guys. Make sure you file a Homestead Act, because that entitles you to have a lower tax rate on your property. I mean, if you're an investor, well, you're an investor, so they assume you have money, which is not completely true. You're just trying to invest for the future and protect your family. Let's see, what other loans we have? Oh, of course, investment loans. Investment loans are always going to be more money at hand. If you're blessed like I am, I have my own loan officer, and he's blessed that he allows me to put down 20% up to the fourth property. After the fourth property, the tax rules all change. It's more complicated. I'll say briefly that usually when you have a property, you have to have 6 months of rent per property that you have. And if you want to get another loan amount, that means if you have 4 properties, that's 6 months on one property, 6 months on another property, 6 months on another property, 6 months on another property. I mean, it adds up. So don't be afraid. I mean, money is not money, it's called currency. So which means you have to continue to move the money in order to make money. The minute the money stops moving, it's no longer currency, it's money, and then the inflation rate comes in and you lose money. It's just, I know it got a little bit technical there, but that's pretty much the basic VA, FHA, conventional, and USDA. I mean, there is a loan programs that assist people that are trying to buy properties that help with the down payment. You make sure you always ask when you're looking for a home. Don't be afraid to ask, hey, I need help with the down payment. And there's programs out there that will help you out. And if that loan officer or that bank doesn't want to give you, well, you're welcome to shop around. And you know, just make sure that you get pre-qualified, not pre-approved, because a pre-qualified is a soft pull and a pre-approval is a hard pull. There's big old difference, and you'll find out. I don't know in the future about. I'll get more into depth into that. But I mean, if you want me to, you guys are welcome to, email me, contact me, put a comment on the bottom, and then I guess I'll expand on that. But I'm gonna continue to bring you content every day. Thank you so much for the opportunity, for allowing me to bring you my daily life of what I do every single day, and the information that I convey to people in order for them to make a good purchase. Stay safe. It's almost Friday. I know people are looking forward to Friday. I don't even know what that is. It's just another day, just yesterday. Keep moving forward. Have a plan. Be thankful for whatever you have. Don't even trust yourself. I mean, just look at the numbers. The numbers will never lie. Have a great day, guys. Valentine signing off.